By Priya Misra, the head of global rate strategy at TD Securities. Great to connect with you, Priya. Very good evening. Priya, inflation in the US, it's more than 9%. It's at the highest level we've seen it at in more than 40 odd years. Surely one would expect the Fed to get aggressive in its monetary policy, but how aggressive do you reckon the Fed is going to be henceforth? And of course, this starts from the 27th of July when the FOMC meets. How do you see the Fed playing out this level of inflation with an aggressive interest rate policy?
Sure, thanks for having me on. It's a really challenging environment for the Fed because they've put in a lot of hikes already, so they've hiked at a very aggressive pace. We expect them to continue to hike. We're still looking for 75 in July, but the market's now pricing in over 90 basis points hikes. I mean, we do hear from some key Fed officials today. We have a key economic data release tomorrow, so we may have to reassess after that. But whether they go 75 or 100, it's really the end point of the hiking cycle. And our view for a while has been that has to get closer to 4% before the Fed is all said and done. And the market had taken that pricing down closer to 3% actually just about a week ago because the market's struggling with high inflation and weak growth. I mean, we know growth is weakening. You talked about the labor market slowing, but what I've been struck by is how unconditional the Fed seems to be in terms of inflation. Inflation is just too high, and now they are worried it's very broad based. It's impacting inflation expectations. So we think that they keep hiking. I actually think what's going to be really tough for risk assets is things are going to slow down, and we've been used to the Fed responding. And I don't think they'll be able to respond. They need inflation much closer to that 2% level. Now, energy prices have declined. So we think headline inflation has likely peaked, but we're at 9%. Even if it gets to 7 or 6%, it's really far from their 2% target. So, what I disagree with the market is the market endpoint is about 3.6. I think that can rise. So I do think front end interest rates in the US can continue to rise as we get closer to 4%. And then the market's pricing in cuts right away. I don't think the Fed will be able to cut with inflation running this high. So I think they're going to pause hiking at some point, and then they're going to wait for inflation to decline. Inflation is a highly lagging indicator. So we really need growth to slow down. A year from then, inflation declines. So I think they're in a bit of a bind, but for
Yes.
now, I think they're going to sound very hawkish.
So, Priya, if the rates keep hiked in that status of getting hiked all the time by the Fed in the near future, how do you think it's going to play out in India? Is it going to become less attractive as an investment destination? Because, yes, for one, the US dollar is going to become even stronger against the Indian rupee, and the differential interest rate between India and the US is clearly shrinking. So, this couldn't bode well for India. What do you reckon?
Right, I do think so. I think emerging market in general, so I'll talk more macro picture. If interest rates are rising and the dollar is strengthening, emerging markets do tend to struggle. Now, I compare it to 2013 when we had a pretty big increase in interest rates, not as much as now, but we had significant build up of positions in emerging markets. That hasn't happened this time as much, and particularly with India, the flows we're tracking, there isn't a positioning washout that has to happen, but the macro fundamentals are not positive. I mean, at some point, the Fed ends the hiking cycle, and when the curve inverts significantly, oil prices fall. I think the backdrop for India starts to get a little better. But right now, until they're on the path to keep raising rates in an aggressive fashion into the highest level we've seen since the 80s, I think people are going to flock for safe haven, and that's going to be the US dollar, and it's going to be US treasuries, particularly longer dated treasuries. I wouldn't recommend anyone buy 2-year treasuries, but the 10-year or the 30-year at current levels start to look attractive. So it's not the best environment right now for India, but 6 months from now, when the hiking cycle is over, I think that starts to change.
Priya Mishra, pleasure having you with us and getting your perspective on what we are seeing by